How important is the current leg of crisis in Ukraine, and if indeed US policymakers and European policymakers impose direct sanctions on Russia, will that be considered as a big global risk-off event? Let's discuss all that and much more with Mixo, Asia ex-Japan equity strategist with Nomura, who joins us live from Hong Kong. Mr. Das, good morning and thank you for joining us. The big talking point is Ukraine.
Good morning.
As a strategist, do you think you're worried about Ukraine, or Ukraine is something which is happening in Eastern Europe and Asian market watchers should not really worry about it?
No, that's not entirely true. We are keeping a watchful eye on Ukraine, but as of now, it does not look like events will escalate to a point where it will start impacting global markets in the same way as it did in early March. So right now we are more focused on the growth outlook globally and how that is evolving. Particularly, we'll be keeping an eye on all the data that comes out this week in terms of what direction it's going in. Also, the earnings season for the first quarter is, of course, underway in large parts of the globe, and so far earnings have been coming in slightly ahead of expectations. So that keeps us quite positive on the market outlook generally.
Mixo, what's the expectation then on the upcoming Fed meeting, and does it seem like again it's going to be tapering and on expected lines?
Yeah. I think so. The Fed will probably continue to taper by another $10 billion of its asset purchases. The Fed is largely on a preset path right now. And it will continue to cut asset purchases by $10 billion at every meeting until it finishes around about October. The hurdle for the Fed to change its policy is really too large right now for it to consider any incoming data to be significantly altering the course of the economy. So as of now, we think they will again cut by $10 billion and they will leave the forward guidance unchanged. At the last meeting, they removed the language about the unemployment rate, and we think that will remain the case this time.
Mixo, but even though the tapering program is on, if I look at the global liquidity situation, both for developed markets and for emerging markets like India and Indonesia, flows are still strong. Are you a bit surprised with the underlying appetite for equities? Because when we started the year, the core assumption was that tapering is bad news for equities and especially for emerging market equities.
Sure. What we found actually is that a large part of the tapering was already priced into flows about 6 months in advance. So if we look at flows into emerging markets, cumulative flows into emerging markets versus the size of the Fed's asset purchase program, and we find that the flows into emerging markets tends to lead the Fed's asset purchase programs, the changes in that, by about 6 months. So we think a large part of what the Fed is doing right now has already been reflected in flows into emerging markets. We saw massive outflows in the second half of 2013, of course, and we think a large part of that was because the Fed was going to taper.
Let's talk about emerging markets now. And within the emerging market basket, I think you've got a big divergence. Top of the heap, you've got India, Taiwan, and Indonesia. At the bottom of the heap, you've got China, followed by Brazil, and then South Africa. What is your take on emerging market as a basket, and what are your preferred emerging market destinations?
Actually, we tend not to look at the emerging markets as a complete whole together. We think there are considerable divergences between the policy setups, between the growth outlooks of all these different countries to consider them together as a basket. So within the global emerging market space, we are actually selectively overweight, but very close to neutral. Our overweights are mostly in Asia and mostly in the export-intensive North Asia. So we have overweights in Korea, Taiwan. We have overweight slightly against the grain in India and some parts of Eastern Europe.
So elaborate your view, Mixo, when it comes to India.
Right, sure. For India, we think, like I said, it's slightly against the grain because India tends to be put together in a basket with the more riskier countries like Brazil, South Africa, Indonesia as being more vulnerable to Fed policy. And while that is true, we think there are considerable differences between India and the rest of these countries. First of all, right now, the political outlook is, of course, a big driver of the Indian market. And on that front, optimism has been rising. And like we heard the previous speaker talking, that there may be a case to be made that this optimism is going too far. But anyhow, if you look at a more longer-term picture, we still think that India appears more attractive than some of these other countries. Firstly, on valuations, India is trading cheaper than, for example, Indonesia and many of these Southeast Asian countries. India's forward PE multiples at 14.9 times, are just slightly ahead of the longer-term averages, which still keeps it quite reasonably valued, especially given the earnings growth expectations of about 17% this year. Secondly, India is also negatively exposed to commodity prices. So while a lot of these countries like Brazil and Indonesia have commodity price exposure, India, on the other hand, benefits from falling commodity prices.
All right. Mixo, appreciate your time and thank you for joining us.
Sure.
Glad you could accommodate this interview request.